Welcome to an incredibly special edition of the Hill Country Podcast. Today, we're absolutely thrilled to have the triumvirate of Tom Fox, Gilbert Paiz, Andrew Gay, joined by John Petrovski, Mike Flanagan, Bart Peterson, and batting cleanup, as always, Walter Calhoun. Gentlemen, first of all, welcome to the podcast. What we wanted to do today was take a look at some macro and micro economic issues that are both nationwide and applicable to Kerrville and Kirk County. I'm going to start with commercial real estate. And John Petrovski worked in this industry for 30 years. He knows commercial real estate in and out. And John, I wanted to just start by asking you, where is the commercial real estate market, and is it still a viable investment vehicle?
Commercial real estate is always a viable investment vehicle. It's a big part of the economy and it's growing. But right now we're in the middle of I think will be a 36-month correction. We're about halfway through, and the corrections was spawned by higher interest rates. When the Fed raised rates and the 10-year Treasury went up 2 years ago, we basically made borrowing rates go from 2 to 3% to 7 to 9%. And that's really changed the landscape for commercial real estate owners and developers. So prices are moving down, values are moving down, leverage is down as well. Banks are sort of correcting their portfolios, posting higher reserves. The regulators are all over them to downgrade their loans and post higher reserves. Banks, the good news is banks are starting to lend again. The ice dam is thawing as far as lending goes. But we're still halfway through that correction. I think the mantra I've heard is survive through 2025. And I think there's some truth to that.
John, what about the sort of broader cultural issues such as working from home or people moving to smaller towns and the lack, or rather the increased capacity in large cities for lack of occupancy? Can commercial real estate be repurposed into some type of residential real estate? Are we looking at a fundamental shift in not simply how people work, but where they work?
Absolutely. The pandemic and the work from home phenomenon was a step increase in a trend that had been happening all along, because technology enabled work remotely, work from home, work from anywhere, really. So what the pandemic did is it just brought those like 15 years of change into 2 years. And so now we have the ability to work from anywhere, and people that can work from anywhere enjoy that flexibility. Some going to the office, some like going to the office 4 days a week, some going 2 days a week. Some working parents like have some parent home 6 days of the week. So the point being is that has changed office building demand. Downtown urban areas, suburban office parks, people are going in less. Tenants are giving back space and going to a hoteling model where people share docking stations. And so there's been a downdraft in demand, fewer workers going in. And so what that means is the businesses, that not only for the office building owners, but for the businesses that rely on office building tenants and occupants being there to get their hair cut, eat lunch, go out after work, that's all changed. So cities have a big challenge. They have to bring more people into their urban cores. They will do that by repurposing some real estate, tearing down some real estate, building new real estate. Getting more residents to live in the urban cores is going to be critical, and that's going to take time. Unfortunately, a lot of office markets are in the first stages of a 5 or 8 year correction. Now, some office markets, Manhattan, Fulton Market in Chicago, there's certain office markets that are doing well, will continue to do well, and attract the highest paying tenants. But that's a minority of the market. The majority of the market is in a big correction.
John, what about this time last year, or a little closer to a year ago, we were together talking about San Francisco and what had happened in San Francisco. And since that time, I think we begin to see that change you're talking about in terms of repurposing downtown, bringing in smaller commercial tenants for some of the big stores that closed. And are you starting, or rather, is the market starting to see that sort of rebuild?
I think you're in the first stages of that for sure. First of all, you start with a town like San Francisco, which is amazingly popular. It's an amazing city. When the downtown, some demands go away, other demands will come in. It's an AI type tenants are coming in, different tenants and office tenants coming in, some big retailers out, different retailers coming in. It's a downdraft, which is difficult if you're an office building owner or lender or relying on cash flow from real estate today, but it's going to repurpose. I think it will be back. It's probably a good time to invest at lower prices if you can find a willing seller.
So what about, let's turn to the banks. And you talked about that in your opening remarks in terms of banks were not repurposing, but readjusting or adjusting their portfolios, but they're having greater pressure from the regulators to have greater reserves. Does that pressure from the regulators lead to a change in lending at the commercial side of things?
Absolutely. As concerns for commercial real estate, lending volumes from the banks dropped significantly. And the reason is simple, that borrowers owning a building with net operating income might have a 2 or 3 debt service coverage ratio, meaning the building's churning off and off net cash flow to pay 2 or 3 times their debt service payment. Well, when interest rates went from 2.5 to 8.5, suddenly that debt service coverage ratio dropped significantly. And the regulators took note of that and said the building's ability to service the debt has gone down. So downgrade your loan, post more reserves. And also importantly, banks need runoff to have a new appetite to lend. Money comes back in and then money goes out again. When the money stops coming back in on refinances, or at least slows down, their ability or desire to lend more money drops as well. So I think that's too is in the middle of the correction. It's starting to pick up again, which is good, but it's a natural consequence of rates spiking up so significantly so quickly.
So Gilbert, if I could ask you in terms of portfolio, could a investor, first of all, an individual investor and perhaps even an institutional investor, still consider commercial real estate as a long-term investment?
Absolutely. I think even with all the problems going on with commercial real estate, for the average investor, we're already invested in real estate, most of us in our homes. But for those investors that find commercial real estate appealing, there's still some appeal there. But investors are going to have to recognize that because interest rates are much higher, they're going to have to pay a higher interest rate, number one. And that means that the lenders, if they can get somebody to lend them money on commercial real estate, are probably going to require higher levels of down payment to make sure that those loans can weather the storm. The other idea is that if you're investing in commercial real estate, you're the owner of the property, and you're going to turn around and lease it out. The people that rent those spaces are going to have to understand that, guess what? Rents are going up. And so is it a good place to be? It always is. But as we tell all investors, diversification is important, and not tying up all of your assets in any one sector of the economy is really important. Because when these things happen, higher interest rates, a slowdown in the economy, higher lending requirements, if you're not prepared, you can get caught real short.
Bart, let me turn to you. You're from Indianapolis, and a large portion, or my perception of a portion of the Indianapolis city economy comes through tourism and hospitality, whether it's a Big Ten football championship, whether it's a convention. There's a large part of the core downtown dedicated to that. Do these sort of trends, in your opinion, really impact that tourism or hospitality, or is something different going on?
I do think something different is going on. While obviously trade associations and particular businesses might, when the economy is not chugging along at the highest rate, might cut back on investment in things like going to conventions or having industry gatherings and that kind of thing. It's not much. And to be honest, the bounce back from the pandemic was remarkably quick from our perspective. You wouldn't necessarily think a city like Indianapolis would be a big tourism and convention destination, but it is because of its location and because it was kind of constructed to be a convention city. And so a big part of our economy revolves around that. And we've bounced back very quickly from the pandemic and seem to be doing really right now. The occupancy rates of the hotels in the city are all very high.
I knew Indy had a vibrant tourism and convention business, but it was driven home when, after the national championship game was played in Houston, Texas, and they interviewed someone the next day on ESPN, and they asked him about Houston, and his response was, "It's not Indianapolis." I was a little bit disconcerted by that, but his point was, because the core physical facilities are located in one geographic area. You walk down the street, you're going to see people in your team's shirt. You're going to see people in the other team's shirts. And you're going to have just this sort of incredible energy that we didn't have in Houston because it's so spread out. Is that something that the city's really been able to play up?
Yeah, absolutely. The city has had a strategy that's gone back 30 to 40 years around making the city a not just a convention destination city, but really a sports focused city. And you hear this around NCAA Final Four tournaments. You hear this around national championships, as you mentioned, and the NFL Combine, which has been in Indianapolis since as long as I can remember. But people run into each other because it's a much smaller city, obviously, than Houston. But everything is concentrated in that area, the football stadium, the basketball arena, and people are all going to the same restaurants, and deals are getting done at the NFL Combine, things like that. So it's really been a selling point for the city as a sports destination for not just for championships, but for all kinds of meetings and things like that, because people aren't spread out all over the place and spending half their time in buses.
Anyone have final thoughts on commercial real estate?
I was going to ask John, do you think that the trouble in commercial real estate could lead to a crash, quote unquote, in the commercial real estate market?
No, I don't think there's a crash. It's just that values have corrected 20% on average, but the beauty of commercial real estate is it varies dramatically by building to building, property type, and market to market. So some properties have appreciated in the last 2 years, but overall, there's been a correction. It's going to take time for lenders to get more active again. Now, equity is available to make good investments today. Plenty of equity is out there. They're just unable to develop or buy at prices that they consider really attractive. The market's just slow right now, but I think it'll pick up in the next 18 months and we'll be back swinging again. I don't foresee any kind of big crash.
I did have something I wanted to add about, you asked Gilbert the question about investors having exposure to commercial real estate. And this is just a point, something I wanted to point out that a lot of us don't think about is that if you have a traditionally diversified portfolio that owns stocks, the stocks represent ownership in companies, right? And what do companies do? They try to churn out profits. They take all those inputs, labor, real estate, inventory, their financing, and they squeeze out those profits, right? They, as a entity, they own real estate, right? And we don't think a lot of times about having exposure to real estate through some of the companies that we own that aren't necessarily known as real estate companies. And the same can be said for when people bring up things about owning commodities like gold. Guess what? In a traditionally diversified portfolio that owns stocks, some of those stocks are companies that do things like mine commodities out of the ground. So you might actually have exposure to some of that stuff without really even indirectly, without direct exposure that you would normally think about.
All right, Gilbert, known you guys, I guess 2.5 years now. And one of the fun things for me has been coming over here and watching you guys watch the market. I would say daily, but it's hourly, it's 30 minutesly, it's whatever it is. But to see how you guys react to the market's changes literally minute by minute, and then how you are able to take what the market is doing and use that information as a data point to look down the road. So one question I wanted to ask is, it seems to me the market leads the economy in many ways, or at least there are more changes more quickly. And then 6 months, 12 months, 18 months later, we see an economic fallout or increase from it. Number one. Number two is this inflationary spike. Many people hope that the Fed might ease up in 2024. It doesn't look like that's going to happen. But how does the issue of inflation play out for someone like yourself and Andrew?
Good question. We certainly do watch the market pretty regularly. The stock market and the bond market tend to be leading indicators of what's going to happen over the next 6 to 12 months. The unfortunate part about the market, though, is that it tends to overreact on the positive side and the negative side. And so Andrew and I are always looking at the market and trying to say, okay, this is what's happening today. How does that really relate to what's going on overall? And how is that going to impact the market over the long term? Because Andrew and I would tell you that when we make investment selections for people, we're always focused on the long term. And so the long term is not today or tomorrow or next week or next month. We are talking about 5 years, 10-year periods at least. Now, a lot of people don't think in those terms, but we do because we need to. If all we did was focus on the short term, we would constantly be churning everybody's investments depending on whatever the market did. And that's really not a productive way to invest for people in the long term, of course. So we certainly do keep an eye on the market. We pay attention to what's going on in the bond market, the stock market, commodities, the economy in general. We're looking at it, but we're always trying to say, okay, how is that going to affect us? Yes, in the short term, but really over the long term. And as Andrew and I like to point out all the time, even though in the short term you might have these things that drive the market up or down, sometimes violently, over time, if you look at history, it turns out that most of the things that happen to us in the market in the short term turn out to not be real big deals. A good example is like 2008. 2008, I'm sure everybody here remembers, it was bad. It was real bad. I remember that. I used to have nightmares. But you have to remember that you can't think in a linear fashion about what's going on in the market. It's not always bad, negative. At some point, it's going to turn around and settle down and then move back up again. And if you look at history books, or just look at '08 as an example, in reality there, '08 was bad, but in 3 years, things had recovered back to where they were in '08. And from that point on, we have done very well. There's been ups and downs since then, but it's one of those things where one day does not make a year, 1 week does not make a 5-year period. We're trying to decipher how that's going to affect us over time. And so we always tell people, focus on the long term. That's really where you're going to make your most money over time.
Yeah, because I really don't think that if whether the Fed cuts in June, which doesn't seem likely now, whether they wait till after the election before 2025, or whether it comes in 2025 or later, if you're a long-term investor, that shouldn't make too much of a difference in your disciplined approach to your long-term plan. It really shouldn't. The short-term stuff doesn't necessarily drive the longer-term view, what Gilbert was expanding on. And one of the things that comes with a higher inflationary environment is obviously higher interest rates. We like to tell people right now, if we think that interest rates are probably going to fall over the next few years, now might be a really good time for individual investors to talk about or think about locking in some of those higher rates right now, if we all think that interest rates are going to fall over the next few years. So there's still some positive spins that you can put on the current higher inflationary environment, even though we all feel it when we go to the grocery store and nobody gets super excited about spending extra money or things going up in price. But there's always some opportunity if you look in the right places.
Yeah, and expanding on that a little bit, Andrew's exactly right. What does higher inflation mean? It usually means higher interest rates. And if you're a saver and an investor, higher interest rates are awesome. But if you're a debtor and you owe money or you're borrowing money or you operate on leverage, this is kicking your butt. And so it really depends on what side of the economy you're on. Are you on the debt side or the investing side? So if you're a saver and an investor, high interest rates are awesome. And you're loving it right now because in '08, you were barely getting 0.5% on a CD. Now you can get 5% on a CD. That's amazing. In '08, you could not live off the interest you were making on your savings. In 2024, you may not be able to pay all your bills on the interest that you're making, but you're certainly making a lot more income than you were before when interest rates were really low. For investors, in spite of what's going on in the economy, good, bad, inflation, high, low, it really doesn't matter. If you're an investor and you're working with a financial advisor, there's always an opportunity out there somewhere. And as John pointed out, you know what? There's a correction in commercial real estate. Now's a good time to look at maybe some dipping your toes into commercial real estate. And as Andrew pointed out, nobody likes paying higher prices for groceries. But if you're a saver and you have a lot of money in your savings account or checking account or investments, it's going to help you weather the storm. It doesn't feel good to pay those higher prices, but if you're making more money, you can weather the storm. But if you're a debtor and you're on the other side of that balance sheet and you're having to pay more money, it's pretty tough right now. So inflation is not necessarily good for the average person, but depending on where you are in the economy, it's not so bad. You'll survive.
Gentlemen, we are at the end of our time. I have wanted to do this for a long time. So I wanted to thank John, Mike, Bart, Walter, Andrew, and Gil. This has been great. I hope we can continue this conversation.